start again for the second session. As you mentioned, last session was very interactive. Actually, there was some very good interaction with all participants. I'm actually happy with that. And let me go back with the first session. Quick revision of what we have, and because actually all the three sessions are very connected with each other. The purpose of this training is, as you know from its title, it's finance for non-finance people. I know all of you are pharmacists, but anyone in any industry actually have to deal with finance. But in order to deal with finance, you don't have to be an accountant. But so this course is teaching you how to deal with financial information, even if you don't have a financial background. Last session or day one, we had we knew how to read the financial statements or financial information, and we knew that we summarized the financial, or any business summarize the financial information in four statements. The first statement is income statement. Second one, statement of retained earnings. Third one, balance sheet and statement of cash flow. Each one have its purpose. First one, the income statement is the statement that summarize for you the performance of the business, your revenues, your expenses, and at the end of the year, it shows for you if you made a profit, a net profit, or net loss. So this is a very important one, and this is the first statement that you start with. Second one, the statement of retained earnings. For sure, where you need to know where actually the net profit you generated during the year goes to. It doesn't go directly to the owners. So you have to keep it in order to decide what to do with this income. Shall I distribute it to the owner, or shall shall I keep the revenue or the profit, or distribute it to the owner? So the statement of retained earnings show for you the income that you retain, and how much you pay out to the owner, and how much you keep to in the organization. The third financial statement shows for you the balance sheet or statement of the financial position. Statement of financial position, it shows for you your assets, is what the company own, and the liabilities what the company owe, and also it shows the capital or the equity. The last one is a statement of cash flows, and it analyzes the movement of cash from where your cash come from, and to where your cash is going on to. So last time we knew how to read the financial information. Today we need to be familiar with how to analyze the financial statements, and this is very important one, because most of you could be an investor. You would like to, and for example, someone of your friends told you, okay, would you like to be an investor in my pharmacy or my business? So you need to decide, shall I go with it? The first question, that when someone offer for you an investment opportunity, or if you would like to invest some money in and buying stock in the stock exchange, the first question you ask, show me the financial statements. This is the first question when someone asks you that, please join me. So for example, let's have I think you face things like that. Your friend, I have a very good idea, and I made a very successful business, and I'm looking for an investor. Would you like to join me? Ask him, show me your financial statements. If he didn't give it to you, so do not start working with him, unless you already make sure that he has a good and a fairly presented financial statements. You take these financial statements, make your analysis, and based on that, you take a decision. Shall you go with him or not? Because I know what happens. This is in real life. I have friends and I face that a lot. Building business based on trust is not enough. I know we trust each other. I know I trust my friend. But when it comes to the money and you start, both of you losing money, your friendship will not last for long. This is my advice to you. Sorry to say that, but this is the truth. So when your friend comes to you, please invest with me, make sure, or at least if you would like to, you started a very good idea. And for example, I had a friend, he's a pharmacist actually, and he would like to start a pharmacy. We start thinking with each other and we made a feasibility study before he started and he invests money. So we find the competition is hard. And you're familiar with that. To start a pharmacy and making a profit from one pharmacy is not an easy one. A competition is difficult, especially if you're facing a chain of pharmacies that already getting good deals from the pharmaceutical companies when they buy medicine, getting some free medicine when buy a lot of stock for medicine. So if you start alone by yourself with one pharmacy, actually is very challenging. So you need to be open to the market and be able to see new ideas. And I think some of the conferences that you attend, maybe in the United States or in Europe, they starting encouraging you to build e-pharmacy. I'm not sure if what I'm saying is true or not, but I think that this is actually a lot of pharmacists are now started to go for to do e-commerce business. So maybe you could start with a very good idea to make, for example, an e-pharmacy, and you would like to ask people, some investors, to make an investment with you in order for your idea to grow. Because a good idea alone does not work. If you have a good idea, okay, every one of you have a very good idea, but actually good idea does not work alone. You have to have a very good financial plan. You need to study more the market. You need to validate your idea and test it. And after that, maybe your money is out and you need an investor. So if you are able to get an accountant and build a reliable financial information for your business, so you can reflect how your business is going, you can be able to do the forecast. So at least you can be able to work with data, not to be only a pharmacist. You can be able to read the data. I'm not telling you to be an accountant. I'm telling you only you need to be able to read the financial information. This is the most important and most important advice to you, how to read the information. And actually, I'm telling you, a lot of programs now is easy that help you in non-financial people to be able to read the financial information and do analysis. I can, at the end of the, once we finish, I can, if you need help, I can advise you what software that you can use in order to do that. Data analytics and forecasting, budgeting, all of that is now easy. All what you need just a good guidance, what software that you can use. It's easy. It's not a big deal. But now what we will study today is how to analyze the financial information. And what is the purpose of analyzing financial information? Why it is good and it is beneficial for you to analyze financial information. Analyzing financial information helps you in only one thing. Only one thing is taking a decision. You need to take a decision to invest in your company and to grow your business, or to invest in your friend's pharmacy or friend's business. You need to take a decision based on what? Analyzing financial information. If you would like to invest with your friend because you trust him, you like him, you cannot say no to him, it's up to you. But don't blame me at the end. Okay? But okay, sorry. Let's go to the information. Okay, let's start.
Will not blame you. Don't worry.
You know, I face that a lot. I see that a lot because actually many family business or a lot of businesses started because of we trust each other. That's good. Okay, but only to keep the business running and the trust continues, you need to have a reliable financial information for your business. If you don't, yes, this is my advice. That's it. Let's start. Okay, first slide we have is the basics of financial statement analysis. Analyzing financial statements involve three categories. The first one, the characteristics, which is and comparison basis and the tools of analysis. The characteristics of financial statements that it involve first thing that we need to measure the liquidity. When you analyze the first thing, when you analyze the financial information, you need to measure the liquidity. How is your liquidity position? What is liquidity? Liquidity is that ability to pay your debts, short-term debts, when it comes due. Are you able to pay your debts? Because actually sometimes maybe you take the medicine from the pharmaceutical company on account. You pay after 1 month, 2 months. It depends on the credit period. Some companies ask you to pay cash in advance. But if you are going to pay after 1 month or 2 months, do you have enough money, liquid money, to pay your debts or not? So you first thing is that you measure liquidity. Second measurement is that you have to measure your profitability. Is your business profitable or not? And compared to other businesses, is it profitable or more or less? And so the third one is solvency. Solvency is measuring are you able to survive on the long run or not? Because maybe you are profitable now, but there is a risk that you will not be able to survive on the long run. Okay, but now you measured your liquidity, profitability, solvency, but measuring this alone and looking into your business itself alone is not good or is not helpful, because in order to see yourself or to say that your business is doing well, you need to compare yourself by previous years. So for example, I have a net profit of 20% this year. Is it good? Yeah, could be. But if last year you have 15%, yes, I have made a gross. So in order to say that you're doing well, you need to compare your performance this year to your performance last year. So this is intra-company comparison. And also you need to compare yourself by another company in the same business. So it is called intercompany comparison. So for example, you have ABC Pharmacy, you need to compare yourself by XYZ Pharmacy. For sure, you will not be able to get the financial information for another company, another pharmacy, but there are some reports that shows for you the industry average. What is usually the information the pharmacies in the whole industry is making. So you can compare yourself with the industry average, with the average performance of all pharmacies in the business. in the country or worldwide, it depends. This is a comparison basis. In order to do your analysis, you need to have tools. What are the tools for analyzing financial information? We have horizontal analysis, vertical analysis, and ratio analysis. And let's start all of this in details. So let's start first with the horizontal analysis. You know, horizontal line is like that. Horizontal analysis is also called trend analysis. Why? Not the trend of Twitter or Facebook, Instagram. No, trend analysis in financial information. For example, you have an account for revenue. For example, your revenues. This is your revenues in dollars, and this is in 2020, 2019, 2018, 2020, sorry, 21, and 2022. So we have revenues start like here, then it goes like this, and then goes down, and then goes up again. So here is the trend. So this is a horizontal analysis. You compare one account over the years. So only one account. So it is a technique for evaluating a series of financial statement data over a period of time. So you compare the revenue over the year, how it's performing. It's growing, it's going down. Your net income, is it going up or going down? This is a trend analysis or horizontal analysis. So you look for each account separately over many years. Its purpose, for sure, it shows the increase or decrease that have been taken in place during different years. And it is commonly applied to the balance sheet and the income statement and the statement of retained earnings. So like that, here is an example. For example, so you can have here the balance sheet, the current assets. Current assets in 2008 was this number, and 2009 was this number. Is it good or bad? You can see that the difference here is 75,000, but you need to convert this into a percentage. How we can do this as a percentage? You divide the difference over the base year. The base year here is a 2008. It shows for you that there is an increase in the current assets with 7.9%. What about the plant assets, the equipment and the buildings you had? So it increased by 26% over the year. What about your liabilities, long-term liabilities? How are you doing with your debts? Are you paying your debts? Yes, I paid my debts, and it decreased by 1.9. What about your retained earnings? Your retained earnings, yes, it has been increased by 38%. This is how much it was last year. This is the amount last year, so it increased. This is a trend analysis, horizontal analysis. You take one account one by one and you see the performance. So for example, what about the net sales? Net sales, it was 1.8 million, and this year 2.2 million, and the increase is 14%, the sales. What about, but in cost of goods sold, the cost of materials that you have increased by 12% as well. What about the net income? Net income have increased by 55,300, which is actually 26.5%. I am doing well this year. So this is called a horizontal analysis. You need, I tell you something, even horizontal analysis, vertical analysis, ratio analysis, you have to use all. Each one serve a specific purpose. If you would like to see, you need to measure each account as a performance over the years. This is called horizontal analysis. As you can see here also, the net income increased 26,000, retained earnings increased by 38,000. This is how you can see that each account is going up or going down. This is horizontal analysis. What about vertical analysis? Vertical like that. Vertical analysis, it's also called common size analysis. Okay. For example, tell me, Doctor, is there a famous pharmacy chain in the Emirates you're familiar with? Like in Egypt, Al-Azabi and
Aster,
Life?
Life and Aster and others in UAE. Yeah. We have
Okay.
Al-Nahdi in Saudi Arabia.
And
So
Nahdi,
different,
okay.
yeah.
So this is a chain of pharmacies. But so that, yeah, some people already responding. Yeah, Life Aster, okay, that's good. Super, that's amazing. So you started ABC Pharmacy for ABC Pharmacy. It's only one pharmacy. Its net profit, for example, at the end of the year, $50,000, for example. But if you compared it with another pharmacy chain like Life, Aster, for example, maybe they have a net profit of 5 million. So how you can compare, for example, I'm just giving an example. So in order, I'm telling you, you cannot look to your company, it's by itself. You have to compare it with the companies in the business. But how you can compare your small company, which makes $50,000 net profit a year, with a chain of pharmacies that makes 5 million a year? This is a big difference. In order to do that, you need to know who's doing well, because I tell you something, maybe your small pharmacy is doing better than the chain of pharmacies, even having bigger amount of income. Do not look to the number, in dollars. You need to convert them to a common size. You need to make the size of your pharmacy, which is small one, the same size of the chain of the pharmacy, which is very big. How to do that? You convert your numbers to common size financial statements. Convert your financial statements to common size financial statements. How to do that? Convert the dollars to percentage. So instead of you say that I have made $50,000 net profit, you can say I have made 10% net profit. And if the company converted its net profit from 5 million, maybe they have made 9%. So comparing yourself with the other pharmacy chain, actually you're doing better, because your net profit is 10% and they're doing 9%. So operationally, you're doing very well. So let's get some examples on this one. So vertical analysis is called common size analysis. How we do that? Let's look at this. We are in vertical analysis. So we look at each year separately. It is not the same as trend analysis. Trend analysis like that. No, we're not doing like vertical. We do vertical analysis. In 2009, what we should do here, for example, in the balance sheet, here is in total assets. You divide each number by the total assets. So the current assets is not 1.1 million, it is 55.6 of the total assets. Plant assets is 43.6%. And what about liabilities and equity? The total here is the same as the assets. You divide each number by the total stockholder equity and liability. So the current liability is not 344, it is 18,000. What about the long-term debts? It's 26% of the total. And for sure, the total assets will be 100% and the total liabilities for sure it will be 100%. I'm sure that this will be easy for you because I know that doctors have to be very good in math. Is that right? I know that. because my son actually would like to be a doctor, and they advise him to be very good in math, and he's very good actually, better than me. I'm not very good in math. So, and also in 2008, I will do the same. So this is a vertical analysis. If you here, so in that case, if you can mix between, and let's see the income statement. What about the income statement? Income statement, for example, you can see here the net sales 100. You divide each number of the net sales. Why I do that in the income statement? Because the driver actually, the first thing that you start with in the income statements, your sales, and you deduct some expenses from your sales until you reach to the net income. So let's go to this one. Yes, net sales, you have here net sales 100%, and you divide your number, each item, by the net sales amount, and so at the end you found that your cost of goods sold is 61% of your sales. So if you sold a medicine with $100, that means that you pay for it $61. It's cost. If you need to make a good, better profit, you need to go down with this cost. So you buy it with 50, for example, or 55, or whatever, in order to decrease the cost. Because from the cost of goods sold, you still have selling expenses and administrative expenses. At the end, you can find that you have generated net income is 263. Forget about this number as a figure. Convert it to a percentage. So divide this amount by the sales. It will show for you that you have generated net profit margin 12.6%. Net profit margin. This is for 2009. What about 2008? 2008, I have made net profit margin 11.4% of the net sales. That means what? If you do horizontal analysis and make a mix between vertical and horizontal, well, that means that compared to my performance last year, I have made a progress, because net profit was 11.4%, and this year I have made 12.6%. Okay, you can also, as you can see here, this store, for example, have generated this is yourself, and this is another company that is a very big company in the market. But they have made, you have made 264 net profit thousand, and they have made 251 million in net profit. Comparing by yourself is far away. But if you convert this to percentage, they actually have the net profit margin of 1.4. Compared to yourself, actually you're doing much more better. This is a vertical analysis. How do you find it? Good. So let's have some quick practice on this one in order to refresh your memories. I will share in the chat the link so you can access directly.
So like last time, we'll click on the link.
Yes. Go ahead, doctor.
Yeah, please explain to them. Please explain to them.
Yeah, all what you need, doctors, that you need to just click on the link in the chat. Just answer. Click, read the question, and select the right answer, and click submit. That's it. It will show for me, and I will not be able to see who responded right or wrong. Just I need to see your reflection on what I have explained now.
Okay, please participate.
So I have now 3 people responded for if you have a
just click the link, please, and answer. And I see here a competition between true and false.
yes, exactly, yes. Mona, please click the link and respond in the link, not in the chat, because I need to compare.
Yeah. Probably she's commenting that the word false is mentioned fail. So fail here,
yes, this is
an
typing.
S missing before the E. So guys,
Typing
the
sorry.
true or false? Okay, true or false, yeah.
Thank you, Mona, for getting that. You know, this is why female or women are very good, because they can spot things like that. They are very
Analytical, yeah. Analytical.
analytical, yes. More precise than us, and they
Okay.
don't for That's
Yeah,
good.
we need more answers, guys. Okay.
Hello, everyone. So, okay, thank you, everyone, for who responded. So, as you can see, from the question, what is the correct answer? So, it shows for me this is like a competition, yes, as you mentioned, Doctor. So, let's see the correct answer. Correct answer is false. Yes, horizontal analysis is like the trend analysis. You compare your current year information in current year with previous years, not with the other items in the same current year. This is a vertical, actually. Let's go to the next question. You can respond also on your phone.
Answer, guys. We have some. We need more.
Yes, 5 people. That's good. 7 people started very well. Actually, amazing. So you okay, that's good. You're reflecting very good, amazing. Yes, true. Horizontal analysis is a trend analysis. Amazing, that's good. Next question.
Yeah, guys,
I'm very happy
more.
actually with your response. Very good.
Yeah, very fast this time. Very good. We need more people to participate. A primary purpose of vertical analysis is to observe trends over a 3-year period. True or false?
That's good. That's good. So yes, it's false, because actually vertical analysis, you need you make analysis only for 1 year. But 3 years, this is actually vertical. Amazing. That's good. Next question. We have 30 people actually in the meeting. We need more, guys. Thank you. Just if you cannot use the link, just click menti.com and enter the code. That's it. So common size analysis express each item in the financial statements as a percentage of the base amount. Yes, that's very good. True. Exactly. Amazing. Next question. In a common size income statement, net sales are represented by yes. We divide each item in the income statement by the net sales. That means that the net sales is 100% because we divide each item by the net sales. And for sure, if we divide net sales over net sales, it will show me 100%. That's good. You are focusing with me very well. Thank you. Next question. In a common size balance sheet, total assets are represented by 100%. So in the balance sheet, I divide everything by the total assets.
It's a competition, these questions.
That's good. That's good. It's true. Yes, exactly. Amazing. Okay, so we continue with the slides.
It's
Again,
it's true or it's false? It's false,
it's true. The correct
It's true.
answer is true. Yes.
Okay.
Yeah. So let's go again to the slides and go for the last section, and a very important section actually in the financial statement analysis is the ratio analysis. Ratio analysis is just ratios, some formulas and use, and actually it's very easy to use. You can get these formulas from where, but the most important here in the ratio analysis is that how to read and the result, how to analyze, how to interpret the result of the ratios, how to interpret them. For example, let's start with the liquidity ratios. What are the liquidity ratios actually? Liquidity ratios, it measures the short-term ability of the company to pay its debt when they come to you. So for example, your short-term debts, are you able to pay them or not? Profitability ratios measures your operating success. Are you doing well or not? Solvency ratios measures your ability to survive over long time. So let's start with the ratio analysis. Ratio analysis, as we can see, is the ratio itself is not meaningful. You need to compare yourself by your performance last year, by another company, and by the industry average. Let's start with the liquidity ratios. The first ratio is a current ratio. What is current ratio? You need to divide current ratio. It measures your ability to pay your short-term debts. Where actually your short-term debts? In the current liabilities. And from where you pay your debts, short-term debts, from the assets. So you need to just divide current assets by current liabilities, and we knew these current assets and current liabilities from last session. I just divide the numbers and it will give me that. It shows for me here that the current assets divided by the current liabilities is 2.96. I add here 2.1. What that means that for every dollar, that means that every dollar of current liabilities, I have $2.6 in assets. So I am in a good liquidity or not? Yes, you are in a very good liquidity, because for every dollar you have as a liability, you have assets 2.96. You're doing very well. As long as it is more than one, you're doing well actually. Okay, let's compare yourself by last year. Last year you are 3.12. It is lower than last year, but you're still doing well. Compared to another company in the business, is actually you are more. Compared to the industry average, actually you're doing well. So that means that my liquidity position here is very good. But there is another ratio. For example, when you pay your debts, you pay from the current assets. What are the components of current assets? Cash, short-term investment, receivable, inventory, prepaid expenses. But what if you need cash quickly? Now, are you able to pay your debts now? Yes, I can do. From where? From your most liquid assets. The most liquid assets that you can convert to cash quickly the cash, short-term investments, and the receivables. You can convert quickly to cash. So let's see if I will pay my debts from the most liquid assets. I will be in a good liquidity position or not. Let's see here. So I will divide only the cash, not the current assets. Cash, short-term investments, and receivable by the current liabilities. And here it will be 1.0221. That means that, yes, you're still in a very good liquidity position because you still more than one. That your cash or most liquid assets is already covering your debts. That's it. Compared to industry average, actually industry average is less than 1.7. So you're doing well, actually. What about receivable turnover? Receivable turnover, it measures how many times you sell. For example, if you have a store for medicine and you sell your medicine to the pharmacies on account, or you are in pharmaceutical company and you sell the medicine on account, or you as a pharmacy, you're selling the medicine for example, hospitals on account, and they pay for you later. So this is called the receivable turnover. How many times you sell you sell the medicine on account, and the customers pay for you. So this is called the receivable turnover. So here you divide net credit sales by net average net receivables. It shows for you 10 times. But what is the benefit of this one? This is a very good one. The benefit of this one will help me in the next ratio, which is average collection period. So I get the receivable turnover from the last ratio as 10 times. So what is average collection period? If you be selling your medicine on account or on credit, not credit card, on credit, that means that the customer pay later after 1 month, 10 days, 2 months, whatever. So what is your average collection period? How long it takes for your customers to pay? It takes here 35, you divide 365 days by 10.2 times 10.2, which is receivable turnover. So it shows for me 35 days. That means that it takes for me 35 days for the customers to pay their debts. Is it good for you or bad? You need to compare yourself by the industry. If this is normal in the industry, more or less, you need to measure that. But I will comment on that later. What about inventory turnover? Inventory turnover, for example, you have an inventory, and you need to focus on this one. This is very, very important for you, because as a pharmacy, you have an inventory. You have a stock of medicine. If you have a store of for medicine and you're selling medicine to pharmacies, for example, also you have an inventory. So inventory turnover, it's cost of goods sold divided by average inventory. It tells me how many times you buy an inventory and you sell it during the year. Okay, it shows for me here, for example, 2.3 times. What is the benefit of this one? The benefit of this one in the next slide, which shows days in inventory. How many days your medicine stay your pharmacy or in inventory until it is sold? And this is very important because of the expiry date. Usually in the pharmaceutical industry, it's important that you have a long expiry date in order to make sure that you don't lose your stock because it stays and not sold. So how many days your medicine stays in the pharmacy or in the store until it is sold? You divide 365 days by the inventory turnover, and it gives me 159 days. 159 means what? How many? 5 months or 6 months? Maybe.
5 months and almost half. Yeah.
Yes. So is it good or bad? You need to compare yourself by the other companies in the business. Is it normal in the pharmaceutical industry that the medicine stays for that period? You need to compare yourself by the industry average. But maybe, for example, it is normal in the business that the inventory, this we focus in this one place. This is a very practical one, and you can apply it in your business. You need to discover, and someone last session asked me this question. You need to discover if you have a slow moving inventory. You need to, you can find that from this ratio. How does that happen? For example, the normal average days in inventory is 30 days. For example, this is a normal. Every year you have the inventory is 30 days. But this year you have as 55 days. So you have more longer than the average. The days in inventory. What does this mean? That means, before I can discover as a financial analyst, I can discover that you have a slow moving, not a slow moving inventory. Actually, it looks that you have expired medicine in your pharmacy, and the person responsible for the pharmacy didn't disclose this to you. So you have as expired stock or obsolete stock, and the storekeeper or the person responsible for the pharmacy or the store did not report that to you. So you have it, and it shows for you in the accounts as you have an inventory, but actually it is not moving. So you have more sales. But why? I used a lot more days inventory. So if you find your days in inventory is more than the average, that means that there is a high likelihood that you have expired inventory in your store.
May I ask a question?
Sure.
Yeah, sometimes I believe that sometimes you call it overstock, like you are making stocks of some goods and not the others. So the inventory, if I have 100 products, some of them are 30 days inventory, others are 50 or 55.
Yes.
How we can deal with this also as well?
Okay, in that case, it is important in the system. You have to generate an inventory report. Some smart system, it shows there is a special report for slow moving items, and it shows for you the movement, inventory movement. So you can print an inventory report for the movement of the inventory, and you start looking by each item, which item is moving more, which item is slow moving, things like that. Especially you have a variety, not every item having the same demand. So it is important that you have your system is not only recognizing your sales, your system also can generate for you a meaningful inventory reports. It shows for you, for example, the movement analysis, and it's an easy. I don't know if your system can generate such kind of report.
There are systems that can show you, and I believe that it can tell you also what you have in your stock. Is this is a stock for 1 month, or this is a stock for 2 months? So based on this, we can adjust my inventories. Like I will make next order, so I will not make order of the products that I have a stock that is enough, like for 2 months, for example. It could be like this.
Yeah, that's good. This is yes. Using software or system will help you a lot in doing that. That's very, and actually it comes with practice. The more practice, it's, you know, most of you are decision makers because you're running business. Make sure that the systems that you are using is capable of generating reports that help you to read the business. And this is actually most of the decision makers that do. Make sure that your system can able to generate analytical reports, that it help you to read the business and be able to take a decision. Thank you. Okay, we finished the liquidity ratio. Let's go for the profitability ratio. Profitability ratio is very easy and it is similar to the vertical analysis. For example, if you need the profit margin, so you just divide the net income divided by sales. So for example, here I generated 12.6% of the total sales. Net sales, what is left as net income is 12.6%. Is good or bad? You divide it, you compare it with the industry average or compare it with last year. For the asset turnover, what is asset turnover? It's also net sales divided by average assets. This is how it measures how efficiently a company uses its asset to generate sales. For example, you have what assets you have maybe in the company, in the pharmacy. You have the store itself, you have the fixtures, you have the machine, counting machine inside or whatever. Maybe you have the computers. These are the assets. So you need to know how efficiently your company is generating sales from these assets. So asset turnover, it will help you in that. So the more or the bigger this one, more efficiently use your assets to generate sales. A very famous one, a return on assets. Return on assets, because you actually invested money in your pharmacy. You invested money in your pharmacy and you have a lot of assets in your pharmacy. Now, how much income, what is the percentage of or the return on these assets? You just divide the net income over the average assets. It shows for me you generated 15%. It's the same as that you make any investment. You buy a land and you rent this land and it generates for you income. You divide the income divided by the cost of the land. It shows for you the return on investment. Return on common stockholders' equity. This is the capital that you contributed. So how much, how many dollars of net income earned for each dollar invested by the owner. Your investment, how it shares in the generation of net income. So it's, for example, it is 29%. If it is more than last year, that means that you're doing well also. Earning per share, this is if your company actually is listed in the stock exchange or it is a corporation and it has its capital in the form of shares. So you need to know how much each share has, each stock have a share in the net income. So you divide net income by the number of stock or shares, and it will shows for you this one.
Can we go back to the previous slide?
Yes, this one, return on, this one, or return or the return on assets.
I think this one, but we can hear the comment from Dr. Muhammad.
So what's your question?
This one, yeah, okay. Yeah, if you have any question, please ask. If you just make a review, just, okay.
A replay, okay.
Okay.
Yeah. So what I'm saying is that you as an owner invested money in the company. You have an investment, invested money, the capital actually. You need to measure actually how much your investment in your company generated net income. Because actually the company or the pharmacy will not generate income by itself. You need to invest money in your company. So how this is the return on your investment in your company, in your pharmacy. So you divide the net income generated by the capital you have contributed to the company. It shows for you, for example, 29%. Is it good or bad? You need to compare it actually with your performance last year. And you need to compare it with the other companies actually in the business, or compare it with the industry average. If you're doing better than all of them, that means that you are doing very good. If you're doing bad, you need to find out, okay, that means that your capital invested in the company is not performing well, or you're not utilizing very well. So you need to focus why I'm not generating high net income, and you start digging out in order to find out why I'm not generating net income. And you can find, for example, I'm not generating high sales. I have a higher cost, for example, higher selling expenses, administrative expenses, and you will find the problem and start fixing it. Is that okay? Thank you. Good. We had earning per share. The last section is the solvency ratios. Solvency ratios, this is very good if you would like to survive for long term, for long period of time. We have, before explaining this one, going deep in this, I need to explain quickly the balance sheets that we have last time. We had last time the balance sheet as assets. This is what the company owns. And we have liabilities and equity. Actually, for example, if you need $100 in assets, from where you will finance buying these assets? Actually, you have two sources of finance. You have two sources of finance. To finance your assets, for example, you need to buy a pharmacy. The pharmacy is an asset. And then you need to buy some, you need to make a decoration. And this is an asset. You need to buy a computer. This is an asset. How much it will cost for you? For example, it will cost you 1 million. For example, $1 million, 1 million real, 1 million dirham, whatever. Okay. So what are your sources of finance? You have only two sources of finance, right? A capital, which is your money as a personal money, or from debt. You take loan from the bank, right? Do you know any other sources? I don't think that there is any other sources. So this is liabilities and this is equity. So maybe I will ask you, and for sure the total will be 1 million, because you need to finance this 1 million. So the total here will be 1 million. So for example, you invested, for example, 700,000, and you take a loan from the bank with 300. Tell me, is this company having high risk, or this pharmacy having high risk to survive, or low risk? Could you please respond in the chat or open your mic? What is the risk of this pharmacy? Is it having high risk or low risk? The company here, the pharmacy, financed its assets, or the pharmacy, from 700,000 from the equity and 300 from a loan from the bank. Or which is better? Tell me, which is better, to finance your assets from your capital or from the bank? I tell you, it is recommended not. Yes, thank you. Thank you, doctor. Yes, it is better to finance actually from the capital. Why? It is having low risk, low risk. Because when you finance from your capital, you don't have to pay it back. You don't have to pay profit until you have profits. But if you finance it from debts from the bank, you have to pay every month or every year interest. And you have to pay the full amount after, for example, 1 or 2 or 3, 5 years. So you have a burden of paying back this debt. But with capital, you don't have to pay it back because it is invested in the company. So it is better if you have lower debt compared to the equity. But let's reverse this one. You have a debt from the bank, 700,000, and you have invested equity only 300. That means what? You have more loans on the bank. So what will happen? Most of your income goes to the paying interest, and the cash that you generate goes to pay the debt. So the opportunity to grow is very low. And you will not, you have a risk, high risk to survive for a long time. So in order to do that, we have the ratio, which is called debt to total assets ratio. You compare the debt to total assets, that means that 45%, that means that your 45% of your assets financed from debts. Compare it with last year. Last year was 50%, so it goes down. That means that very good. So if this goes down, actually it's amazing. You're doing very well because you decrease the risk of your company. Compare it to the industry average. You are more than 100 industry average. So that means that you're doing very bad than the industry average. You need to improve yourself and pay your debts in order to be able to survive. What about interest times interest earned? Times interest earned here, it covers, because if you have a high debt, you pay a lot of interest to the bank. So how many times your net profit covers the interest? So here, for example, it covered 13 times. So this is the more it is this one. So this is very good. Last year it was 9.6, and this year it is 13 times. So you're doing better than last year. Actually, this is a summary of the all ratios. You can use it if you would like to use it in the future in your business. It's very easy, and it has here the purpose of its use. It's very helpful. If you don't have the slides, you can Google it. It's an easy, you just write ratio analysis, and it will show for you all the ratios. All what you need to do, get this information from the financial statements and divide, and now you can be able to read this financial information. Any question before we go to the questions and practice? We can have a quick test here, and just you have 20 seconds to answer. And also I send them as a message and the link in the message, or if you don't have you can use go to menti.com and use actually the link. All what I want you to do is now enter your name or a nickname as you like. We have 5 participants now. Please join. Just 10 questions to reflect. It is not you pass or fail. It's just practice and the reflection of the information that we had in the session.
Okay, competition like last time?
Yes, as competition, we'll see who will win. Please join. Come on, guys.
You will give the gift, Dr. Ahmed, to the winners.
Yes, I will give a free system, accounting system. Okay, so we have 6 participants now. Please, could you please join us? Okay, let's start. Yes, that's true. Oh, that's false. Each item is generally stated as a percentage of net income. No, it is a percentage of net sales, not net income. Net sales, sorry. We learn actually from mistakes. So each, when vertical
Yes.
analysis, yes,
We learned from mistakes, yeah.
yes, a percentage of net sales, not net income. That's good. Okay. لم ينجح أحد. Okay. Next question. I forget to remove this option 3. Yes, sorry. Yes, it's true. That's good. Let's see. Okay, we have 7 people, and yeah, I didn't let you told you that the faster actually getting higher points. That's why you will find the difference.
Yeah,
That's
so
good.
correct and fast.
Correct and faster. Okay. That's good. More people join. Yes, true. True. Yes, profitability ratios measures operating effectiveness. Amazing. So let's leave the leaderboard. Okay. People goes from the top to the down. Okay. Let's see.
But the hustler is the highest.
Yes, but Thomas is the fastest, but last time he was wrong. Okay.
Yeah.
We'll see. People from down will go up now. Let's see. We still have 7 questions. This is a trick one, actually. Do you remember we
think
have
so, yeah.
liquidity, profitability, solvency? Aha. But at least 5 people, that's good. Current ratio measures the liquidity, not profitability. That's good.
So 3 people will go down now.
Yes.
Yeah.
Okay. Yes. Hustler is still in the advanced level. Okay.
Yeah.
Amazing.
Wow.
Noor is going
Hustler,
up
and now we
now.
have Noor. We have
Okay. Be
Iskandar.
careful. Be
Hey.
careful.
Ah.
Okay.
Focus, guys.
It's an easy one. Yeah,
Oh,
a circle analysis. So we have horizontal analysis, vertical analysis, and ratio analysis. My question is, which one of the following is not? Is not.
okay. So
Okay.
only 3 are correct.
Hustler is going down. Noor is going
Yeah,
up
we see
now.
Skandar and Noor are moving.
Okay. Okay.
Okay,
Noor at the top.
competition, guys. Okay, Noor is now number 1. Very good.
Comparative balance sheet means that we compare 2020 with 2021, for example.
So you already give the answer.
Yes. 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 But some people didn't get it.
Oh my God. Now 3 people will go up. Okay.
Okay, still Noor and Skandar is still in the. Okay, that's good. Ahmad now is the fastest one who's going up. Be careful, guys. Do you remember we divide each item by, in the income statement, by what?
People has to study, not just to focus.
Yes, but net sales. Yes, we divide by net sales because every item in the income statement is a percentage of net sales. Doctor, we learn from mistakes. So we'll see who's
Yes,
the guy.
but only if you answered correct.
Noor and Skandar didn't get it. Hustler and Ahmed's going up. Ahmed is moving up now. Okay. Now they are equal. We have 4 people are equal. Noor, Iskander, Hustler, Ahmed. So anyone who's go down is try to focus the next slides. Okay. 3 questions left. This is a conceptual one. What is the benefit of the ratio? Ratio analysis.
Again, it's not easy.
That's what see what's happened. Only 2. Only 2 get it. I'm happy that people are really doing that because actually it's very close. You can see that most of them are correct actually, but which one is the best one? Best answer, correct answer. So,
Yes.
so it is the benefit of ratio analysis is showing for you the relationship between different items in the financial statements. So, for example, if you when you compare your net income by the total assets, so it shows for you what is the relationship between the assets, your assets, and your net income, your performance. What is that? Why your net assets, your assets is good in generating income. So ratio analysis shows a relationship between 2 items. That's good. 2. Who are these 2? Ahmed and Mino. Okay.
But Mino was the fastest.
Yes, but Noor is still.
Still is the boss.
Okay, we'll see. Tough competition. 2 questions left, guys. We'll see. It's an easy one. This is the one that measures your ability to pay your short-term debts. Yes, liquidity ratio. Very good, amazing.
Let us see what Noor will do and Skandar.
Oh, Ahmed didn't get it.
Ahmed and Skandar and others. But I believe Noor will stay number one.
Now we'll see Noor.
Well done, Noor.
Listen, the last question. Wait, the last one. We'll see now Noor and Hasler. We'll see.
It's not easy. Could be easy for you, but I believe not easy for
We'll
some.
see from the answer.
We'll see the
But
answers, yeah.
From the answer, actually, most people
Wow.
already get
Wow.
it right. Yes.
Okay, the majority answered correct.
Yes. That's very good, actually.
We'll see the first three, what happened to them.
Hasler didn't get it. Okay.
Okay. So Hasler and Ahmed are down.
Noor. Amazing.
Noor.
Amazing.
Congratulations, Noor.
And everyone
the winner.
will actually. That's amazing. I enjoyed a lot.
Yeah.
This is the end for me. I would like to thank you for your time, for your collaboration. Everything is doing well. Actually, it's going well. Thank you so much for your time. Thank you, Doctor.
Thank you so much. We really appreciate. It was really great presentation, and you made a very nice summary in the beginning. And I believe, guys, it's practical in our life. We have some real examples that we can implement. So the famous statement, if you will not use it, you will lose it. That I learned it from Dr. Samir years ago. So let us use it, not to lose it. Okay. So I believe interactive participations and such a competition, and Noor, the winner. So I believe it's something really great. We're really happy for having this. Dr. Noura Ghadir is raising her hand. Do you want to ask a question or comment or something? Yeah, probably you're raising your hand, not by intention. So I need here Dr. Mahrouka. So please, you can unmute and talk. So
I want to ask about the certificate. When will we get the certificate?
Yeah, the certificate for the health economics already distributed to everyone. The certificates of business planning and hospital crisis management will be distributed within this week. After the third session with Dr. Ahmed Musa, so we'll distribute the certificates for the finance for non-finance.
Okay, thank you.
Thank you so much. And if someone attended the health economics and you did not receive your certificate, please let us know. Okay? Rather than this, we will send the rest within this week. Hopefully, in this week, we'll send both business planning and hospital crisis management. Okay. If there's no more questions, so we can convene now, and thank you so much, Dr. Ahmed. We really appreciate your presence. We appreciate the presence and support from the panel, Dr. Samir, Dr. Mohammed Salama, and appreciate the sponsor and support from SEMFA. And really thank you to you all attendees and for attending and for active participation and for the nice competition. And looking for the third and last session from Dr. Ahmed Musa by next week on the same timing. Thank you so much.
Thank you so much.
Goodbye.
See you next week.